Hello everyone, this is Suraj Sharma and I am going to present before you financial management topic cost of capital. The learning objectives in these slides will be understanding the meaning of cost of capital, importance of computing cost of capital, types of cost of capital. Let us now understand what is the meaning of cost of capital. Every business requires capital for starting up a business. It may obtain funds through different sources such as issuing shares, debentures, or taking up a bank loan. Each source of funds carry some cost. For example, the company has to pay interest on loans taken or pay dividend to the shareholders. These expenses, such as loan interest, dividends, etc., are often referred to as the cost of capital. Here you can understand that cost of capital means that a minimum amount of return a company must generate in order to recover the costs. That is, every company has some costs to incur. Alright, so these costs must be recovered. That rate is known as cost of capital. Let us now understand the cost of capital by some eminent authors. According to Milton H. Spencer, the cost of capital is the minimum rate of return which a firm requires as a condition for undertaking an investment. According to Hunt, Willem, and Donaldson, the cost of capital may be defined as the rate that must be earned on the net proceeds to provide the cost elements of the burden at the time they are due. According to James Van Horn, the cost of capital represents a cutoff rate for the allocation of capital investment of projects. It is the rate of return on a project that will leave unchanged the market price of the stock. Here, this line means that we have read that the cost of capital is the minimum rate of which a firm requires as a condition for undertaking an investment. That means it is a cutoff rate where at that rate of return there is no profit or no loss. Hence, since there will be no profit or no loss, that will leave the market price of the stock unchanged. That is, you can call that the break-even rate of profit is known as cost of capital. Now, let us understand the importance of computing cost of capital. Various decisions are based on cost of capital. We have read earlier that the cost of capital is the rate which a business must obtain which is able to clear off its expenses. There are many importance of computing cost of capital, but let us discuss any two. Number one is cost of capital is important in capital budgeting decisions. Here, in capital budgeting decisions, the cost of capital will act as the discount rate, and it acts as a target rate which a company must obtain in order to pay off its dues. That means we calculate the present value using a rate of return. Say in various sums we have seen that calculate the present value at 10% rate of return. Then this rate of return, this percentage of return, it is the cost of capital rate of return. Alright. On the other hand, if the cost of capital is more than the internal rate of return, it is better to forego the investment proposal. Cost of capital is also important in capital structure decisions. The cost of capital plays a significant role in determining the best capital mix for the company. That means there are various mixes. Out of that, which mix of capital should we take such that the cost of capital is low? So in capital structure decisions, this cost of capital is most important. Now let us understand the types of cost of capital. It can be classified into future and historical costs, specific and composite cost, explicit and implicit cost, and average or marginal cost. Future and historical cost. Future cost of capital refers to the estimated cost which can be attributed to any future expansion of the project, which means that when any project is about to be undertaken, beforehand the cost of capital is estimated. It is known as the future cost of capital. And the historical cost means that the capital has been procured, and the cost to procure that capital which has already been taken, that cost is known as historical cost of capital. Now specific and composite cost means specific cost of capital. Here it means that when there are various sources of capital, say equity capital, debt capital, right? So the cost of procuring these specific capitals, when it is calculated, say for example if you want to calculate the cost of only equity share capital, that will be known as the specific cost of capital. And on the other hand, the composite cost of capital means that if we want to include all the types of capital we have taken, say for example in a business has taken loan and issued equity shares and debentures. So if the business wants to know its cost of capital as a whole, then it will be calculating weighted average cost of capital, which is also known as the composite cost. We shall learn about these in detail when we discuss about it. Explicit and implicit cost. Explicit cost of capital is the rate of return which equates the present value of the funds received by a firm with the net present value of expected cash outflows. That means, see this equation here, N0 is the amount of fund received, right? And IT is the cash outflow at period T, and K is the discounting factor or explicit cost of capital. Here we can see that N0 is the present value of the cash received by the firm, which equates to the expected value of the cash outflows. The rate which will make these two amounts equal, it is known as the explicit cost of capital. And the implicit cost of capital is the opportunity cost which is foregone to take up any particular project. Say for example, in case of retained earnings, the part of profit which is not distributed to the shareholders could have been invested somewhere else. So this cost which is foregone by the shareholders, this is known as the implicit cost of capital. We can see that only the retained earnings have implicit cost of capital. All the other forms of capital have explicit cost. Average and marginal cost of capital. Average cost represents the weighted average cost of capital. That means simply we have seen that the weighted average cost of capital, it is the cost of capital which is calculated by taking all the elements of capital. And the marginal cost, it is referring to the weighted average of cost of new funds obtained by the company. Say for example, if a company has some existing capital and it wants to introduce some new capital, so the cost of the additional capital, it is known as the marginal cost of capital. With this we end our slide. Here are some references which you can see. Thank you.